Okay, let's get right into it. Welcome to today's Explainer, where we're going to unpack what we're calling the CFO's playbook. We are taking a real deep dive into the strategic intersection of equipment financing, liquidity optimization, and of course, some incredibly complex tax codes. Whether you're leading a construction firm, running a manufacturing plant, or managing a transportation fleet, mastering these specific elements, that's the difference between just barely operating and truly scaling. So, I want to kick things off by asking you a pretty critical question. Is your business sitting on millions in trapped capital? I know, it sounds a little dramatic, right? But honestly, it is a stark reality for so many organizations. In asset-heavy industries, we constantly see businesses that look highly profitable on paper, but behind the scenes, they're just constantly struggling with liquidity. Because, let's face it, growth requires upfront investment, and your day-to-day expenses, they simply don't wait around for your receivables to finally clear. To tackle that, we've got a 5-play roadmap for you today. We'll start by unlocking trapped working capital. Then we'll compare leasing versus financing strategies. After that, we're going to look at maximizing those massive Section 179 deductions, navigating the very real compliance trap of ROU asset taxes, and finally, building out some strategic hybrid financing approaches. Let's jump in. Play number 1, unlocking trapped working capital, finding the cash. Look, before we even talk about acquiring any new assets, we absolutely need to find the cash you already have. Because the core foundation of literally any corporate finance strategy is that cash is king. And what's wild is the sheer scale of the opportunity here. According to JP Morgan's Working Capital Index report, there is an estimated $700 billion plus of working capital trapped as free cash flow right now across industries. $700 billion. That's capital businesses have legitimately earned, but just can't access because it's bogged down in inefficiencies. So how do you actually grab your slice of that $700 billion pie? Well, the secret lies in something called process mining. Think of your business as leaving millions of little transactional breadcrumbs across your ERP and financial systems every single day. Process mining essentially reconstructs these end-to-end processes to show you exactly where your capital is leaking out. It highlights supply chain bottlenecks that are tying up cash and idle stock. It flags invoice-to-cash gaps where late payments are just wrecking your liquidity. And it spots payment term misalignments, like, when you're paying your suppliers way faster than your own customers are paying you. Now, once you actually know where your capital is, you've got to decide how to leverage it to fuel your operations. And that brings us to the 2 primary ways to finance: asset-based lending, or ABL, and cash flow loans. If you're a manufacturer or contractor dealing with high working capital intensity, ABL is often an absolute lifeline. Your borrowing base is tied directly to the value of the tangible assets you already own, stuff like your equipment, inventory, and receivables. On the flip side, cash flow loans are tied to your earnings power, specifically your historical and projected EBITDA. We're going to talk about how to blend these two later on, but understanding this fundamental difference right now is crucial. Moving right along to play 2, leasing versus financing strategies, acquiring the assets. So we've optimized our operations, and now we need to acquire some new assets without just burning through all that hard-won liquidity we just found. Acquiring assets means navigating what is essentially a complex 6-dimension tax matrix. And honestly, this isn't just about figuring out your monthly payments. If you leased, your payments are generally operating expenses, which keeps your cash flow nice and smooth with zero down. But if you finance, both the asset and the liability are going to hit your balance sheet, which alters your debt-to-equity ratios. However, financing unlocks some massive first-year tax deductions. So the real question for a CFO isn't just which one is cheaper, but which structure creates the strongest financial outcome for our specific tax profile right now. And that brings us perfectly to play 3, maximizing Section 179 deductions, or as some like to call it, the big, beautiful bill. $2.56 million. That is the 2026 IRS Section 179 deduction limit. Think about that for a second. Instead of depreciating a massive piece of heavy equipment over 5 to 15 years, businesses can deduct the full purchase price in the very first year it's placed in service. And here's the real kicker. You literally do not need to spend cash to claim this deduction. You can finance 100% of the equipment and still take that multi-million-dollar deduction against your taxable income this year. It just completely rewrites the math on acquiring heavy assets. Say you're bringing in a massive excavator. If you're having a highly profitable year, buying and financing this equipment essentially eliminates the tax liability on that income immediately. But, and this is a huge but, the asset must be operational and placed in service by December 31st to qualify for that specific tax year. If it gets delivered on January 1st, you're waiting a whole year for that benefit. Now, you might be wondering, what if you want that massive Section 179 deduction, but you also really want the low monthly payments of a lease? Well, there's a strategic loophole for that, called a First Amendment lease. It's this unique structure that lets you claim the full tax deduction up front, keeps your initial capital intact, and even gives you an option to convert it to a fair market value lease at the end of the term. It's pretty much a true win-win for both capital preservation and your tax strategy. Let's actually look at a real-world example to see how this plays out. There's a site development firm called Summit, and they needed to upgrade their fleet with 2 excavators and a dozer. Total cost? About $1.1 million. By utilizing a First Amendment lease, they acquired all 3 machines with 0 upfront payment. Their CFO noted that their payments were incredibly low, but here is the best part. They deducted the entire $1.1 million under Section 179, saving approximately $352,000 in taxes right off the bat. They kept their cash, got the equipment they needed, and completely slashed their tax bill. All right, let's pivot to Play 4, Navigating ROU Asset Taxes, the Compliance Trap. We've spent some time talking about saving money and buying equipment, but now we've got to enter the danger zone of some highly complex lease accounting standards. First, just a quick definition so we're all on the exact same page. A right-of-use, or ROU asset, represents your contractual right to use a leased asset. Under the new ASC 842 rules, almost every lease over 12 months, we're talking your office space, your warehouses, your vehicle fleets, all of it, must now be recognized on your balance sheet as an ROU asset alongside a corresponding lease liability. The old days of just hiding operating leases off the balance sheet, yeah, those are completely over. But here is exactly where the trap snaps shut on people. You are essentially operating in 2 parallel universes now. On one side, you have your book reality. For accounting purposes under ASC 842, you've got this massive ROU asset and liability sitting right there on your balance sheet. But on the other side, you have your tax reality. And guess what? The U.S. tax code completely ignores ASC 842. If the IRS considers your agreement a true lease, that massive ROU asset on your balance sheet literally has 0 tax basis. It just doesn't exist to the IRS. So this disconnect creates an absolute accounting nightmare, and it leads to some incredibly common audit pitfalls. The single biggest red flag? Claiming tax depreciation on a book-only ROU asset. Because remember, if it's a true lease for tax purposes, you literally cannot depreciate an asset that has 0 tax basis. Companies also routinely mess up by failing to calculate the deferred tax implications of these phantom assets, or they update a lease term for accounting but completely forget to adjust the tax classification. If you aren't tracking these parallel systems perfectly, you are basically just rolling out the red carpet for an audit restatement. Okay, take a breath. We made it through the tax code. We are on to our final play, Play 5, Strategic Hybrid Financing Approaches. This is where top-tier CFOs really shine. They bring all of these concepts together to build an optimized, highly resilient capital structure. Because the truth is, you rarely have to choose just one single type of financing. The smartest companies out there use a hybrid approach. They might use asset-based lending to fund their working capital against their heavy equipment and inventory, while simultaneously layering on a cash flow term loan to finance a new acquisition or a major expansion. But to build this correctly, you really have to evaluate your asset composition, figure out how stable your cash flow actually is, and really understand your own tolerance for strict financial covenants. Just consider a major construction site for a second. A blended financial structure aligns your financing directly with your operational reality on the ground. You leverage the hard assets, like the physical cranes and the steel, for efficient, low-covenant borrowing, while leveraging the future earning power of the completed contracts to actually fund your growth. It's really not about just finding the simplest loan you can sign. It's about architecting a capital structure that fundamentally supports the physical, day-to-day reality of your business. Which brings us to the end of our explainer today, and I want to leave you with a question that honestly should keep every financial leader on their toes. If the IRS audited your ROU and fixed asset register today, are you ready? Have you claimed Section 179 properly? Are you accidentally depreciating phantom assets? Are you sitting on a mountain of trapped working capital that you could be using to scale right now? Look, the tools are absolutely out there to optimize your liquidity and your tax position. The only question is, are you using the right playbook?